quick disclaimer, you will definitely ignore my advice. Go in search of what you think is the right answer to your trading problems via social media or whatever, some trading guru tells you. Then a few months down the line, maybe a year, maybe even 2 years, you'll realise that the advice that I'm going to give you today would have saved you a lot of pain. It happened to me. I ignored advice from a lot of people who were in a position that I wanted to be in, thinking that I knew better, or thinking that other people who showed off a lot on social media knew better. And I was wrong. And it probably added a year or two to my trading journey. We need to look at why most traders struggle. They're generally in a boom and bust cycle. So they have periods of success, and then all of a sudden they'll give back that progress. They'll be frustrated. They'll have a clean start. How many clean starts do you want? They'll be annoyed for making the same mistakes over and over again. Why do you have periods of success? So you've got your strategy and you've got market conditions. Market conditions are not considered by most traders, and these are the traders that struggle. You don't have to consider them all the time, but if you can understand how market conditions cause you to struggle in your trading, you can use that information to improve as a trader. So what happens when you're making money from the markets? Your strategy and market conditions are in harmony and you can extract money from the markets. What happens when you start to struggle? Well, one of those things changes. You either change your strategy or market conditions have changed. And usually what happens is that market conditions change, then you adapt your strategy slightly. You would have been overconfident through that period of success, so you'll sort of double down on your strategy. Then the psychology starts to drop off as well when you make irrational decisions. And this is all because market conditions have changed. Now, generally look at it as in there being two types of market conditions: subdued market and a risk-driven market. Now, there are two different versions of risk-driven markets as well. So when you're in a subdued market, your strategy will work out perfectly a lot of the time. Technical analysis will work on your currency pairs, on gold or silver or oil or whatever market you trade. Then all of a sudden, market conditions will change. In simplistic terms, financial markets, investors have got their money spread across all different markets and they're happy to leave it where it is until market conditions change. Then they have to move their money around the markets to preserve their capital and offset any losses that they're about to take. So if something happens to cause uncertainty to the markets, so for example, right now we got the Iran situation. If something kicks off in the Strait of Hormuz and it gets shut down, stocks are going to drop. Now, the stock market, people plow money into that and it goes up when the world's in harmony and everything's fine. As soon as something happens to stop that harmony, people want to pull their money out of the stock market because that's seen as a risky investment. And then we've got a risk-off situation. What happens in that risk-off situation? Stocks drop. People are selling stocks for dollar, increasing the demand for dollar. Pound US dollar is going to drop. Euro USD is going to drop. Gold is going to drop because that's priced against US dollar. So if stocks are dropping, antipods are dropping. So that's Aussie and New Zealand, sometimes CAD as well. So if they're getting weak, pound Aussie dollar, pound New Zealand dollar, that's going to go higher. Now, if you're about to enter a trade on gold or whatever market, whatever currency pair, and price is coming towards your pending order, you need to have an alert in front of that order to understand why is price getting there. It might just be that there's no risk flows and it's okay to take your trade. But if the US stock market is dropping and that is causing gold to drop against the US dollar, you don't want to take that trade. Now, we'll have a look on the charts in a minute to show you what you can do. But essentially, you should just cancel that pending order and wait until the US stock market hits a level. And I say levels, I only ever mention levels because that is the only technical analysis that I use. And the reason for that being is that whenever there is risk flows in the markets, S&P 500 doesn't stop until it hits a level. Nothing else, not a fib, not a moving average, nothing. It is a level. Price action, pure price action on the charts. All we need to do is stick a line on the charts. And you will see that most of the time when S&P 500 flows are happening, price hits a level, then the market turns. So whereas you were going to enter gold here, but because S&P 500 is dropping and dropping, gold's going to keep dropping. As soon as S&P 500 hits a level, that's going to pull back, and then gold's going to pull back. So instead of buying gold there, you could have waited for S&P 500 to hit a level and then buy gold, or whatever currency pack, or whatever currency market you're trading, any market at all. Risk flows move the whole market. So for something that's so important and so, throughout the whole of the markets, I don't understand why it's not considered by anybody. And in fact, I know why it's not considered, because it seems a little bit complex. And when a trading guru wants to sell you a trading course, they need to dumb it down a little bit so it sounds a little bit complex, but not too complex that it's going to put people off. Well, I don't care about that. I'm just going to give you the facts of exactly what happens to the markets. And you can take that information, and if you add that to your journaling and data collection documents that we give people, you can understand why your trades lose. Then you can avoid those losing trades. And not only that, you can start profiting from these scenarios where you used to lose money. And you see how we can remove that bust cycle from boom and bust. At first, it'll be boom, and then slight bust. And then it'll be slightly less bust. And then it'll be boom and break even. Boom and break even. But that's still an upward trajectory. And then eventually it can be boom, and then we have two different versions of trading. Boom is standard type trading. And then when market flows are happening, when this bust period would happen, we have defensive trading. So you'll be in normal trading, defensive trading, normal trading, defensive trading. Still making an upward trajectory rather than boom, bust, boom, bust. Okay, so let's get on the charts and we'll have a look at some examples of when risk flows are in play. And you can do this exact same process by looking at the losing trades that you've had and then comparing these driver markets and seeing if that is what caused the losses to happen with your trades. Now, again, I'll reiterate, trading is boring. This is the crap work that you need to be doing to make an improvement as a trader. It's not all the social media bullshit that you see. It's about putting the graft in, but it's the right graft. A lot of traders think that spending time on screen and working hard yields results. It doesn't, unfortunately. You've got to be doing the right work. There's so many different aspects to trading, so many different paths that you can go down, but you've got to find something that suits your personality, and doing this crap work will help you establish an edge in the market. Remember, if you know when not to trade, you're going to cut out a lot of losses. So you're going to have a lot more profitable weeks and a lot more consistency. So if we have a look at a split screen now, so we got pound US dollar here on the left hand side on the hourly chart, and we'll pull up S&P 500 on the right hand side. So we're here on the hourly. Trading view is great because you can put your cursor across the charts and it lines up, so you can see perfectly what's happening across markets. This is a really good example to look at first, because you can see that S&P 500 is making a move lower, and that exact move is replicated on pound US dollar. Not sure the reasoning behind it, but there's a level there as well on pound US dollar. So people would have been trying to buy here, but when prices come in towards a place that you want to take a trade from, it's essential that you have alerts in place. So when prices come in near, you can check across the market to see if conditions are still conducive to taking that trade. Now, if price is moving lower and you get an alert set off, one of those checks is to check for market flows. So we'd look straight at S&P 500. What's happening? Well, that's moving lower. That's causing dollar strength across the market. Now, if we leave pound US dollar and look at euro US dollar, you will see that exactly the same move is happening on euro US dollar. And again, there's another level here. So traders would probably be looking at buying that. But once your alert gets triggered and you can understand what is causing the moves, these are not subdued market conditions, risk flows are in play, you can cancel that order. And what we can do is wait until S&P 500 gets to a level. It won't be every time. Sometimes we might not have a level, so there won't be a trade. But what we've done instead is avoided a losing trade. sometimes S&P 500 will hit a level, and then we can buy pound US dollar or euro US dollar just from a better price. So instead of buying here and having that drawdown, we can wait and wait and wait. And let's say, for example, there was a level here on S&P 500. As soon as price hits that level, we then buy pound US dollar. So instead of buying at this level here, we buy here. And then when S&P 500 makes a pullback, you see the currency pairs make a pullback as well. Let's have a look at gold to see what was happening there as well at the same time. Gold also moving lower. So people were taking buys on gold, would have been inviting drawdown, hitting a stop loss. But what happens when S&P 500 hits its level? Gold pulls back as well. So I don't even need to go into more examples, but if you want to know more, you can drop me a message, drop me a comment. I'm happy to help. I put information like this in the Discord channel all the time because I'm passionate about it. I'm passionate about helping traders improve because I know how much of a struggle it can be. So if you can understand risk flows, so I don't even care what happens here. There's no need to understand what is causing the move in the market. It could have been anything that made risk sour. So this is a risk off move. People don't want to be in the stock market, which is seen as a risky investment. People pull their money out and they went into dollar, which caused dollar to get strong, which caused gold to move lower, which caused Euro USD to move lower at the same time. Let's have a look what Aussie and New Zealand did at the same time. So you see they moved higher because people didn't want to be in stocks and they didn't want to be in Aussie and New Zealand either because they're interlinked when risk flows are in play. So if the stock market is not appealing and that's dropping, Aussie and New Zealand are not appealing either. So they're going to make a move higher. So once you can correlate these moves when they're happening, you can avoid losses. It might seem really complex, but it isn't. It takes just a few trading sessions of watching the moves, setting alerts, understanding, and with our journaling and data collection documents, it does all the work for you. You just input the data, and then once you know how to review that data, the improvements will be instant. So that is risk flows. Boring, I know, but boring makes money.